Hello everyone. Today, we'll discuss how to profit and get rich from the recession. You may have heard that a recession is the wrong time for investment. You've heard it all wrong. Investors wait for recessions for those juicy pockets of opportunity to appear. As the age-old expression goes, millionaires are made when the markets are down. The same vintage wisdom is distilled by the legendary billionaire Warren Buffett. Be greedy when others are scared and fearful when others are greedy. You may not be a Warren Buffett, and the chances are pretty slim. If you are watching this video, let's be realistic. The question is, how can you benefit from a recession? How can you turn a meltdown into your advantage for that first? Before we continue, please subscribe to our Money Facts channel and turn on the bell notification if you want to boost your money management so you may live the life you want. Let's talk about what a recession is. 2/4 of an absolute GDP decrease in a row constitute a recession. Additionally, the U.S.'s real GDP shrank at an annual rate of 1.6% in the first quarter and 0.9% in the second. Recessions are prolonged downturns in economic activity, usually associated with falling retail sales, lower industrial production, declining wages, and higher unemployment. The good news? Downturns also provide plenty of opportunities for regular people to build wealth. Simply put, a period of a significant drop in economic activity is known as a recession. The typical indicators of a recession are a rise in unemployment, a decline in profits, and a general collapse of financial markets. Some countries, like Great Britain, France, and Germany, consider 2/3 of consecutive negative GDP growth. There is no official definition of recession. According to the National Bureau of Economic Analysis Committee, a recession is a significant decline in economic activity that affects the entire economy and lasts for more than a few months. This decline is typically reflected in production, employment, real income, and other indicators. When the economy hits its peak level of activity, a recession starts and ends when it reaches its trend. Considering the above definition, the focus should be on a broad set of methods, including GDP, employment income, sales, and industrial production. To analyze the trends and predict a recession based on economic activity, only beat yourself up if you couldn't predict the 2007 recession or the pre-post-corona economic downfall. Even the professionals get it. And more often than not, even though an economy can show signs of a downward spiral months before a recession occurs, determining whether a country is in a downturn in the true sense usually takes time. For instance, the NBER committee spent a year announcing that the U.S. recession started in December 2007. The decision-making process entails accumulating and sorting through several variables, many vulnerable to adjustments after their first announcement, to generate a broad fall in economic activity over time. In addition, different activity measures may exhibit conflicting behavior, making it challenging to identify whether the country is suffering from a broad-based economic decline. We are now moving on to the history of recessions. As mentioned, a recession is followed by economic degrowth, high unemployment, and cold markets. The pattern is similar as far as the historical records are concerned. Simultaneous recessions have occurred in developed economies in the past 40 years. The mid-70s, the early 80s, the early 90s, and the earlier 2000s. The United States continues to have the biggest economy in the world and has close economic and trading ties with many other countries. Most of these global recessions are directly linked with U.S. recessions. The purpose of going over the history of recessions is to learn about the causes and use those causes to your advantage instead of going under. One of the trendiest topics in economics research right now is the study of the reasons behind recessions. Recessions take place for a variety of reasons. Some of them are connected to sudden fluctuations in the cost of the raw materials needed to create goods and services. For example, a sharp hike in crude oil prices can indicate a trend. As energy becomes more expensive, it directly affects the overall price, leading to a decline in total demand. A recession can also be prompted by a country's decision to decrease inflation by engaging in contractionary, monetary, or fiscal policies by either cutting spending or raising taxes when used extravagantly. Such policies can result in a reduction in demand for goods and services, thus causing a recession. Conversely, some recessions result from credit booms, including in 2007. The credit boom recession's root cause is the financial markets problems. It occurs when asset prices climb significantly, credit is expanded quickly, and debt rapidly accumulates. As corporations and households face difficulties meeting their debt obligations, investment and consumption are reduced, eventually decreasing the economy. Thus, economic degrowth translates into a recession. Recessions, however, can also be brought on by a drop in foreign demand, particularly in nations with significant export industries. The negative consequences of recessions in powerful nations like Germany, Japan, and the United States quickly spread to their trading partners. As these countries reduce their imports, it tanks the economies of the exporting countries. Thus far, we have discussed recessions, their causes, and their consequences. How likely is a recession to occur given the structure of the U.S., national or global economy? As it stands, this is likely. Many economists view recessions as a feature, not a bug, in the system. There have been 122 complete recessions in 21 advanced economies between 1960 and 2000. In the last 4 decades, there has been one recession every 2.5 years. So the point is, do not be afraid. Think about turning the tide to your advantage before moving on to the final point. Now, let us talk about the core characteristics of a recession. Could you recognize the opportunity if it knocked on your door? Let us. Although each recession has unique features, they often exhibit several common characteristics. A typical recession lasts about a year and often causes high output costs. As a result, a recession is typically characterized by a 2% decline in GDP. The reduction in consumption is often tiny, but industrial production and investment register much more significant declines than GDP. A significant drop in international trade occurs as exports, primarily imports, fall severely during periods of recession. The unemployment rate always increases, and inflation falls slightly because the overall demand for goods and services is truncated. Recessions tend to decimate financial markets along with the destruction of the housing sector and equity values. Now, here comes the million-dollar question: how can you profit from all the chaos, upheaval, and turmoil? It's simple. Be prepared, think differently, and jump on the opportunity before it becomes expected. Remember, it's about thriving, not surviving, so here are some surefire tips to give you an edge in the market. Pay attention and follow one high-yield sector during the recession. The easiest and most profitable step is to invest in industries that yield high during recessions. These sectors include, but are not limited to, communication services, consumer staples, energy sectors, financial services, healthcare, information technology, real estate, and utilities. To clarify, healthcare includes biotech and pharmaceutical companies. The consumer staples comprise food and beverages, household and personal products, alcohol, and tobacco. 2 Bulk buy, cost-saving items that are needed today and will be required in the future will save even more money if the recession continues. Besides, buying and measuring also save you lots of money. Moreover, when demand increases, you can resell the same items for double or triple the original price. 3 Are recession-proof. You must invest in recession-proof companies. That is, besides the examples above, their services are necessary and tangible to buy stocks in companies that make real things and turn a profit. Another recession-proof sector is the food industry or real estate. During a recession, the housing market takes a downward turn, as do home values. Well, it is a disaster for others, but it is an investment opportunity for savvy investors like you. You can rent a property to a tenant and generate a steady income while you've wait out the recession. Once it is over, and the values start to surge, sell at a profit. 5 Dividends. Dividend stock investment is another excellent opportunity to capitalize on the recession. Look for firms and hedge funds with low debt-to-equity ratios and solid balance sheets. Follow the dividend aristocrats. They have been sailing the high tides of turning in profits for at least 25 consecutive years. Most of all, do not panic. The recession has gotten a bad rap, but you can turn it into a profit for yourself. Believe in yourself and take risks, to quote the man who conquered it all. When there's less competition, you can better establish a market position. Of course, you should consider beginning a side hustle if you aren't ready to leave your job and fully commit to a company idea. There's no magic formula for getting rich quickly. Whether investing in stocks, real estate, or starting your own business, it's essential to research and evaluate your financial situation first. And millionaires are made when the markets are down. This video has come to an end. If you enjoyed the video, please subscribe, like, and comment. Enjoy your day, and thanks for watching.